Hello everyone. In this video, we are going to discuss the last capital structure theory, that is Modigliani-Miller approach. So, in the previous videos, we have discussed first three capital structure theories, that is net income theory, net operating income theory, traditional theory, and this is the last one, that is Modigliani-Miller approach. See, hypothesis is identical with net operating income approach if taxes are ignored. So here Modigliani-Miller approach is similar or identical with net income approach, that is NOI approach, if taxes are ignored. So if there are no taxes, so it is similar to net operating income approach, that is NOI approach. However, when corporate taxes are assumed to exist, their hypothesis is similar to the net income approach. So when corporate taxes are assumed to exist, so if there are corporate taxes, their hypothesis is similar to the net income approach. So actually, what is net operating income approach? So net operating income approach is irrelevance theory. So irrelevance means there is no relationship between capital structure and value of the firm. Okay, and here NI approach is related to relevance theory. So relevance theory means here there is a relation between capital structure and value of the firm, overall cost of capital. Okay, according to NI approach, when there is a change in capital structure, ultimately there is a change in overall cost of capital as well as value of the firm. But coming to the irrelevance theory of net operating income approach, so it is irrelevance. So it is irrelevance means whatever it may be, the debt equity mix, the value of the firm and overall cost of capital will be same. Okay, now look at the first one. In the absence of taxes, that is theory of irrelevance. So theory of irrelevance means it is similar to NOI approach. NOI approach. Okay, yes, see, the theory proves that the cost of capital is not affected by changes in the capital structure, or says that the debt equity mix is irrelevant in the determination of the total value of a firm. In the opinion of Modigliani and Miller, two identical firms in all respects except their capital structure cannot have different market values or cost of capital because of arbitrage process. In case two identical firms except for their capital structure have different market values or cost of capital, arbitrage will take place and the investor will engage in personal leverage as against the corporate leverage, and this will again render the two firms to have the same total value. See here, it is nothing but actually the Modigliani-Miller model, the Modigliani-Miller method. This is the approach related to theory of irrelevance when it is, if in case of absence of taxes, if there are no taxes, the theory is related to, or the theory is in the form of irrelevance, the theory in the form of irrelevance. So here the main concept is arbitrage process. So here the arbitrage process plays an important role in the Modigliani and Miller model. So according to this theory, here the capital structure will not affect the debt, it will not affect the determination of the total value of the firm. So here the capital structure will not affect in the determination of the total value of the firm. So here in the arbitrage process, the investor will engage in personal leverage. The investor will engage in personal leverage rather than corporate leverage. So here they will engage in personal leverage rather than corporate leverage. So here, what are the assumptions for the Modigliani Miller approach when there are no taxes? See here, the first one is there are no corporate taxes, and second one, there is a perfect market. So perfect market means here the same information is available for all investors. So here perfect market means the information is available for all investors. Investors act rationally. So that means here investor can borrow without restrictions as the same terms and which a firm can borrow. So investors can borrow without any restrictions. So investors can borrow money without any restrictions as the same terms on which a firm can borrow. సో ఫర్మ్ అనేది ఎట్లయితే మనం బారో అంటే డెప్ట్ తీసుకుంటుందో అదేవిధంగా ఇన్వెస్టర్స్ కూడా ఎలాంటి రెస్ట్రిక్షన్స్ ఉండవు అని చెప్తున్నాడు. అండ్ నెక్స్ట్ వన్, ద ఎక్స్పెక్టెడ్ ఎర్నింగ్స్ ఆఫ్ ఆల్ ద ఫర్మ్స్ హ్యావ్ ఐడెంటికల్ risk characteristics. So that is EBIT will be same. And next one, that is the cutoff point of investment in a firm is capitalization rate. So what is the cutoff point in investment means here the cutoff point of investment in a firm is capitalization rate. So that is called cost of, capitalization rate is nothing but cost of capital. And next one, that is all earnings are distributed to the shareholders. So here all earnings are distributed to the shareholders. So here another assumption that all earnings are distributed to the shareholders. That means so the dividend payout ratio is 100%. That means there are no retained earnings. So this is what about the Modigliani Miller approach when there are no taxes. Next, coming to the approach when corporate taxes are assumed to be exist. So when corporate taxes are assumed to be exist, according to Modigliani and Miller, the value of the firm will increases or the cost of capital will decreases with the use of debt on account of deductibility of interest charges for tax purpose. Thus the optimal capital structure can be achieved by maximizing the debt mix in the equity of a firm. So here according to the theory of relevance, that means when taxes are assumed to be exist, so here the value of the firm will increases or the cost of capital will decreases with the use of debt. That is here the capital structure will affect the value of the firm and overall cost of capital. So here thus the optimum capital structure can be achieved by maximizing the debt mix in the equity of a firm. So here optimum capital structure can be achieved by maximization of debt mix in the equity of a firm. So according to the MM approach, the value of unlevered firm can be calculated as, so here what is value of unlevered firm? So here what is unlevered firm means here the unlevered firm is the firm without debentures. A firm without debentures can be called as unlevered firm. A firm without debentures in their capital structure, that means only equity shares are there, equity capitals are there, then it is called as unlevered firm. So here the value of unlevered firm is equals to VU is equals to earnings before interest and tax divided by overall cost of capital. Okay, earnings before interest and tax divided by overall cost of capital, that is EBIT divided by K naught into 1 minus T. EBIT divided by K naught into 1 minus T. And the value of levered firm is, so here what is the value of levered firm? See here, this is the value of unlevered firm. So unlevered firm is the firm without debentures. So here what is the value of levered firm? So here the levered firm is the firm with amount of debentures. So here value of levered firm is equals to value of unlevered firm plus TD. So here value of unlevered form can be calculated by using this formula. Okay, no problem. Plus TD. So T where value of U VU is equals to value of unlevered form, which we can get from the previous step. T is the rate of tax and D is the quantum of debt used in the mix. D is the quantum of debt or the amount of debt used in the mix. So here Modigliani Miller, according to the Modigliani Miller method, here we can say that it can be, and the Modigliani Miller method can be studied in two ways: when there are no corporate taxes, when there are existence of corporate taxes. When there are no corporate taxes, here we can say that the theory is irrelevance. That means when in the situation of no corporate taxes are exists or no corporate taxes are there, at that time the value of the firm, or we can say that the overall cost of capital, may not be affected by capital structure theory. But when coming to the when taxes are exist, then it is called as the theory of relevance. So in this situation the value of the firm and the overall cost of capital, the value of the firm and overall cost of capital depends upon the capital structure decision. Okay, so this is what about the theoretical aspect of Modigliani Miller hypothesis. Next we'll look at a problem. See, let us discuss Modigliani Miller approach numerical problem. The following is the data regarding two companies N and M. Particulars: company N, company M. So company N is unlevered firm, whereas company M is levered firm. So what is unlevered firm? Unlevered firm is nothing but a firm without debentures, whereas the levered firm is a firm with debentures. Now EBIT 2 lakhs and 2 lakhs, debt 7%, nil, rupees 10 lakhs, cost of capital, that is K naught 10% and 11.5%. Explain how under Modigliani and Miller approach an investor holding 10% shares of company M will be better off in switching his holdings to company N. So here the two companies information is given. One is unlevered firm and another one is levered firm. So here the two companies EBIT, debentures and cost of capital was given. So here he is asking to show how under Modigliani Miller approach an investor holding 10% of shares of company M will be better off in switching his holdings to company N. So here an investor who is holding 10% shares in company M, if he better in switches holdings to company N, అంటే ఈ దీంట్లో 10% ఆఫ్ షేర్స్ని అతను విత్డ్రా చేసుకొని సేమ్ 10% ఆఫ్ షేర్స్ని కంపెనీ ఎన్లో ఇన్వెస్ట్మెంట్ చేసినట్టయితే మన ఏమంటారు మోడిగిలాని మిల్లర్ ప్రకారం, సో మన క్యాలిక్యులేషన్ చూపెట్టినప్పని చెప్తున్నాడు. ఓకేనా? సో హియర్ లుక్ హియర్, క్యాలిక్యులేషన్ ఆఫ్ సొల్యూషన్, క్యాలిక్యులేషన్ ఆఫ్ వాల్యూ ఆఫ్ అన్లీవర్డ్ ఫర్మ్. Unlevered form means here company N, that is company N. So here value V is equals to EBIT divided by cost of capital, that is K naught. So what is EBIT here? EBIT is 2 lakhs. So here 2 lakhs divided by what is cost of capital? 10%. So that is 0.10. So that is equals to 2 lakhs divided by 0.10 is equals to 20 lakhs. So here value of unlevered firm is rupees 20 lakhs. Now calculation of value of levered firm. So here value of levered firm means here what is the value, what is levered firm here? Company N. So that is company N. So here value of firm is equals to S plus D. So S means value of equity shares plus D means value of debentures. So here S is equals to, so we don't know what is the value of S. So we know debentures. So here the debentures are given rupees 10 lakhs. So here debentures are given rupees 10 lakhs. So to calculate value of S, this is the formula: EBIT minus interest divided by cost of capital. So here what is EBAT? So EBAT is given as rupees 2 lakhs. So we have taken 2 lakhs minus interest. So here interest should be calculated on debentures. So here see, here debentures D is equals to 10 lakhs, interest 10 lakhs into 7 by 100, that is equals to rupees 70,000. Now 2 lakhs minus 70,000 divided by what is cost of capital? Here the cost of capital is given 11.5%, that is equals to 0.115. So that is equals to 2 lakhs minus 70,000, 1,30,000 divided by 0.115. So that is equals to 11,30,435. So this is the value of shares, I mean S, that is equity shares. Now coming to the value of firm, V is equals to S plus D. So here what is the value of S? 11,30,435 plus what is the value of debentures in the given problem? Here in the given problem the debentures are 10 lakhs. So here if we add S plus D, then we will get the value of firm, that is the value of levered firm, that is the company M. The value of company M is equals to rupees 21,30,435. See now, after calculation of value of unlevered firm and levered firm, now we will compare these both firms. So here firm S value, S means cost, I mean value of equity shares, and D means here debentures, and value of firm S is V is equals to S plus D. See here unlevered firm, that is company N, unlevered firm, that is company N. So here value of shares 20 lakhs because there are no debentures, then the value of the firm is rupees 20 lakhs. Then coming to levered firm, here company M, here calculated S value is 11,30,435, and there are debentures 10 lakhs. The total value of the firm is 21,30,435. Now here see, the value of unlevered firm is 20 lakhs and the value of levered firm is 21,30,435. So here the value of unlevered firm is consisting of only equity, because unlevered firm means no debentures, the firm without debentures. Here value of levered firm means the firm, I mean levered firm means the firm with debentures. So here as per our calculation, equity shares are 11,30,435 and debentures are 10 lakhs, that is equals to 21,30,435. So here in this comparison we can understand that the equity shares, the amount of equity shares in unlevered firm is 20 lakhs and in levered firm is rupees 11,30,435. Okay, so in unlevered firm there are no debentures and in levered firm there are debentures of rupees 10 lakhs. So if you observe the value of the firm, unlevered firm as well as levered firm, here the value of levered firm is more than unlevered firm. But actually according to the Modigliani Miller method, so here irrespective of debt equity mix, the value of the firm should be same, but here the value of levered firm is more than the value of unlevered firm. So here see, value of levered VL is greater than value levered unlevered firm, value of unlevered firm. So therefore arbitrage process can be exist where we can reduce the value of levered firm and increase the value of unlevered firm. So actually according to the Modigliani, the value of firm should be same, but here the value of unlevered firm is less than the value of levered firm. So to make these two firms value same, here we are following the arbitrage process. So here the arbitrage process can be followed. See here in the question given in the problem, according to approach, an investor holding 10% shares of company M. So company M means levered firm will be better off in switching his holdings to company N. So now here from company M to company N, investor is migrating. That means investor withdrawing his shares from company M to company N. So he is transferring his shares from M to N. So here look at the first point, to acquire 10% shares of N company for which cash required by an investor is 2 lakhs. See here, to acquire 10% shares in N company. So N company lo manam 10% shares manaku kavalanunte, if you want to acquire 10% shares in company N, how much we need? We require 2 lakhs rupees of amount, that is 10% of 20 lakhs. So 10% of 20 lakhs. Second one, so here the first point is clear that to acquire 10% shares of N company for which cash is required by an investor is rupees 2 lakhs. So మనం N కంపెనీలో 10% షేర్స్ పర్చేస్ చేయాలి అని అంటే ఇన్వెస్టర్కి ఎంత అమౌంట్ అవసరం అండి? 2 lakhs అవసరం. ఎందుకంటే హియర్ వాట్ ఈస్ ద 10% ఆఫ్ 20 lakhs అంటే 10% ఆఫ్ 20 lakhs is equals to 2 lakhs. Yes, coming to the second point, an investor will sell his 10% holdings of company M, resulting cash inflow of rupees 1,13,043. So that means to acquire 10% of shares from N company, so we need to sell 10% shares of M company. So if you sold 10%, if you sell his 10% holdings company M, here resulting the cash inflow of rupees 1,13,043. So here because the amount of shares is 11,30,435 in company M. So దీంట్లో 10% మనం సేల్స్ చేస్తే then the cash inflow will be మనకు వచ్చే అమౌంట్ ఎంత అంటే 1,13,043 rupees. Okay, and coming to the third point, further he don't want to change his risk position, so debt equity ratio should be same. So further an investor he don't want to change his risk position, so atanu elanti risk position ni change cheddam anukuntunnadu. So here the debt equity mix or the debt equity ratio should be same, hence he will borrow rupees 1 lakh at the rate of 7% to maintain the debt equity ratio. So to maintain the debt equity ratio, investor borrows 1 lakh rupee at the rate of 7%. So here the rate of interest, here the rate of interest is 7% now. So he will borrow 1 lakh rupee at the rate of 7%. So that is 10% of 10 lakhs debt. So company total debt to 10 lakhs lo 10% enta ante that is 1 lakh. Now his personal leverage is 1 lakh rupee at the rate of 7% to maintain debt equity ratio. Now we will solve the problem. See, step by step there are 3 steps are there. See, step 1, computation of funds available to an investor holding 10% shares in company N. So మనం కంపెనీ N లో 10% షేర్స్ కొనాలనుకుంటే మన దగ్గర అవైలబుల్ ఉన్న ఫండ్స్ ఏంటో ఇప్పుడు డిస్కస్ చేద్దాం. సో కమింగ్ టు ద పాయింట్ 3, సో బై సెల్లింగ్ హిస్ ఈక్విటీ షేర్స్ ఇన్ కంపెనీ ఎంలో ఈక్విటీ షేర్స్ సెల్ చేయంగా వచ్చిన అమౌంట్ ఎంత? 1,13,043. And coming to the point 4, hence he will borrow, so 1 lakh rupee he borrow as a debt at 7% to maintain the debt equity ratio. So 1 lakh he borrowed at the rate of 7%. So equity 1,13,043 and debt that is 1 lakh, conversion to personal leverage. So this is personal leverage. 1 lakh is the debt converted into his personal leverage. Now here the total funds available 2,13,043. But to invest in M 10% shares, so మనం 10% షేర్స్ ఇన్వెస్ట్మెంట్ చేయాలంటే ఎంత అవసరం? 2 lakhs అవసరం. But here we have 2,13,000. Coming to the step 2, here the amount required to hold same 10% holdings and surplus thereof. See here total funds available for an investor, here we calculated 2,13,043 in step 1. See here 2,13,043 here. Next, less amount required for 10% stake in company N rupees 2 lakhs. So మనం కంపెనీ N లో ఇన్వెస్ట్మెంట్ చేయాలంటే మనకు కావాల్సిన అమౌంట్ ఎంత? 2 lakhs. Now we have 2,13,043 but we need only 2 lakh rupees. So from 2,13,043, if you invest 10% shares in company N, then what is the surplus amount? The surplus amount is 2,13,043 minus 2 lakhs, that is equals to 13,043. So therefore an investor will be better off by rupees 13,043 by switching of company M to company N. So దీని అర్థం ఏంటి అంటే, సో ఇన్వెస్టర్ విల్ బి బెటర్ ఆఫ్ అంటే ఇన్వెస్టర్ ఈజ్ బెనిఫిటెడ్ బై రూపీస్ 13,043 బై స్విచ్చింగ్ ఆఫ్ కంపెనీ M టు కంపెనీ N. అంటే ఇన్వెస్టర్ అనేవాడు కంపెనీ M నుంచి కంపెనీ Nలోకి 10% షేర్స్ని విత్డ్రా చేసుకొని కంపెనీ ఎన్లో ఇన్వెస్ట్మెంట్ చేసినందుకు అతనికి వచ్చే బెనిఫిట్ ఏంటి అంటే, హియర్ ద సర్ప్లస్ ఆఫ్ అమౌంట్ రూపీస్ 13,043 rupees. Now coming to the step 3, calculation of profit of an investor from both of the companies at 10% holdings. So now in this step we are going to calculate what is the profit of an investor from both the companies at 10% holdings. See here, the EBIT which was given in the problem is 2 lakhs and 2 lakhs for both the companies, and less interest. So interest should be deducted. See here, 10 lakhs in company M, there are 10 lakhs rupees of debentures are there. So 10 lakhs into at the rate of 7%, that is equals to 70,000. So here interest is applicable to company M because company M is having 10 lakh rupees of debt at the rate of 7%, but company N is don't having any debentures. So that is why here we have taken nil. Now EBT is equals to EBIT minus interest. So 2 lakhs minus 0, that is 2 lakhs. 2 lakhs minus 70,000, that is 1,30,000. So here profit for 10% holding. See here, EBT is equals to 2 lakhs and 1,30,000. So here an investor is having only 10% shares, 10% holding now. So here we are calculating profit for 10% holding. So this is overall profit for the company X and this is overall profit for the company M. So but now we are calculating what is the portion of profit for the investor. So here 10% investing na. So 2 lakhs లో 10% అంటే 20,000, 1,30,000 లో 10% అంటే 13,000. Now we'll deduct interest on personal leverage. So here interest on personal leverage means to invest in company N. Here investor borrowed 1 lakh rupee at the rate of 7% per annum as a debt. So 1 lakh into 7 by 100, that is equals to 7,000. Now we'll deduct this interest on personal leverage, that is 20,000. So his portion of profit from company N is 20,000. His portion of profit from company M is 13,000. Now we are deducting his interest on personal leverage, which is applicable in case of company N, because to acquire 10% of shares in company N, he borrowed rupees 1 lakh at the rate of 7%. So that is equals to 7,000. Now 20,000 minus 7,000, that is equals to 13,000. 13,000 minus nil, that is equals to 13,000. Now see here, after deduction of interest on personal leverage, see here the amount which is available for the investor in the form of net profit is 13,000 and 13,000. See here, both the firms net profit is same for the investor. So here it is clear. Now it is clear that investor will earn same amount of profit with rupees 13,043 in hand. So అతను M కంపెనీ నుంచి 10% షేర్స్ని విత్డ్రా చేసుకొని N కంపెనీలో ఇన్వెస్ట్మెంట్ చేయడం వల్ల సో అతనికి వచ్చిన ప్రాఫిట్ ఎంత అంటే 13,043 వితౌట్ డిమినిషింగ్ in the net profit for the both the companies. So this is what about the Modigliani Miller approach theory as well as the arbitrage process. I think you all hope, I hope you are all understood. Thank you.